Welcome to the Full FX Unfiltered. My name is Colin Lambert. I am publisher of the Full FX, and I'm delighted to be joined by an old friend, John Ashworth, CEO of Caplin. Lovely to see you again, John.
And you, Colin. Always good to see you.
Yes.
Thank you for the invitation.
Yes, more than welcome. I wanted to talk to you today actually about something that's becoming more of a theme in some of my writings, because it's being raised more with my conversations, and that's actually what's happening with regional and specialist banks. We understand that the big get bigger, and we understand that there's different models, business models out there, but I thought it'd be really good to tap into your knowledge around what are the regional banks actually doing at the moment to stay relevant in foreign exchange.
Well, it's a big area. Well, we've talked about in panels and conferences in the very recent past. But I think today, more than ever, the regional banks are relevant for two large reasons. One is they have relationship with their clients. They have a relationship that's important within the credit pyramid, but also important just because of the history of trading relationships, but also the fact that a regional bank is likely to have lots of other things about a person's or a small institution or a small corporate's wallet, beyond just the foreign exchange trading. And the second thing is they've got likely to have specific currency expertise. So those two things put together, I think, are the immediate answers to any suggestion that the days of the regional bank are numbered, and if anything, they're more and more important.
That said, obviously we live in a highly automated world.
We do.
And customers like the convenience of automation. Yes. Where are these banks in terms of their tech capabilities? Are we still working our way towards some sort of end goal?
Well, the regional banks went quite early in equipping themselves with the electronification of the market. They invested in single dealer platforms from really the early 2000s onwards. There were sort of one or two main providers of that technology in those days. And there was very much a one-size-fits-all, which answered the needs of them to be seen to be doing something, in an electronic way. But with regional banks, you have typically a huge range of segmentation in the clients. You have very sophisticated ones who are only going to talk to you on an API and probably going to be talking to multi-dealer platforms and probably going to be talking to the big banks if they've got the right credit and KYC credentials. But you've also got a lot of customers who are running their own businesses, who are intelligent but inexperienced traders who actually want to speak to a person, might be happy to trade on a single dealer platform but want to have a salesperson or a sales trader on the phone doing some trading on behalf of whilst they're doing it. So there's a mixture. But I'm hesitating to produce these figures because we're coming up at the end of the year to the latest BIS triennial survey. So it's the wrong season to be quoting figures from the previous one. But if we look at what happened in contrast from 2019 to 2022, the proportion of voice to e-traded flow was about the same from 2019 to 2022. But there was a marked shift away from MDPs to single dealer platforms in that period. I believe in 2019 about 28% of the flow was via SDPs and 29% was indirect. SDPs then went up to 35% and indirect MDPs went down to 22%. So there's definitely a shift. And I think there are three reasons for that shift. Firstly, there is, other than the very highly liquid pairs, there is definitely a cost argument. And the cost argument is if you're not paying brokerage to a multi-dealer platform, that amount of money or tax is not in the system and therefore not in the price. So the customer's going to get keener prices and keener risk-adjusted prices overall. And the science and the economics around that are now much, much better understood with technology companies like BestX, the whole research and analysis that's going on in TCA and so on and so forth. So the spotlight is shone on those cost economics. So that's one reason. Second reason, we touched on this earlier, a well-constructed single dealer platform encourages a relationship with the customer, paradoxically. Far from sticking the customer out on a screen to do self-service, actually, if you get it right, if you get the user interface right, if you get the telephone support for those less confident customers right, actually it's a way of building the relationship. And of course, all these customers are people who are used to using apps to contact their bank for their personal savings and loans. So why shouldn't they have technology to talk to them about treasury and capital markets things? And I think the third point, relevance of the single dealer platform for the regional banks, is the data they're getting from it. So they're not having to unpick their share of data from other platforms, and what they've got is theirs, and they can focus on that.
At some cost as well.
At some cost.
Yeah.
But the costs are coming down too.
Yeah. Not sure the external market data costs are coming down. But yeah, they may be. We may be shocked by that. So, okay, so I must confess, I fundamentally agree the STP remains still very, very relevant. What do you see these players doing to their STPs now, and what are they looking at doing maybe going forward?
Well, what we're seeing a lot of is people retooling. Right. So some of the original single dealer platforms were built on what we would now regard as legacy and quite ancient technology. I can quote names like Silverlight. I think HTML5 is the way that things are going now. So there's a lot of retooling, and some of that retooling is simple as we've got customers in faraway places with unreliable internet technology. We need to support browsers in a more reliable way. We have a customer, I won't mention their name, who made a decision to retool precisely for that reason. So I think just getting up to date with more stable, more supportable, more serviceable technology, and technology where, frankly, the labour force is skilled in how to program it. So that's the first thing. The second thing is, to the extent they had gone down a one-size-fits-all route, I think there's a focus on greater customisation. The whole technology around single dealer platforms has democratised considerably. Famously, the matrices and the neos at the big banks in the early 2000s were costing literally hundreds of millions of dollars. You can now, get yourself up and running with a brand new single dealer platform for hundreds of thousands of dollars, and that will be serviceable. Of course, you can add on all sorts of bells and whistles and make it more or less customizable. But the whole thing is democratized, and certainly within reach of the smaller regional banks. So customization is an important thing. The next thing is to make complex products simpler. So a real problem that some of the regionals have is with the throughput that's required to deal with complex products, whether that's options or it's structured products or it's cross-asset class products. The ability to simplify things so that customers can be a little bit more self-serving, to reduce the bottleneck. So again, a eager but under-skilled salesperson is not having to always go to the structuring desk to say, help me out on this reverse knockout with twiddly pineapple bits on top, and they're just restricted to selling vanilla puts and calls, but they can assist the customer in doing that themselves. I think we touched on this as well. The notion that internal customers are an important customer or client of the single dealer platform is very relevant. You won't find any sales manager who wouldn't like more out of the sales folk they've got, and they would like more skilled salespeople. And every single bank is looking to achieve efficiencies, which is a polite way of saying cutting costs, which in banks and white collar industries is a polite way of saying getting rid of people. So they're trying to do anything they can to make the salespeople more efficient, taking away some of the boring admin tasks, so altering limit orders, looking at watch lists, notifications and all that sort of thing. Technology can help with all of that, and I think they're looking to their single dealer platform to do that. And I think the final area is looking at post-trade. So the unbelievably dull aspects of affirmations, confirmations, which are heavily people and process heavy. If you can automate that, you can literally reduce keying errors, entirely. You can reduce the time from hours to minutes to get all that stuff done, with all the associated benefits of execution and slippage risk being eliminated. And your customers think you're a bit more of a digital bank for a part of the process that you wouldn't have thought they'd appreciate.
So is then another part of that challenge actually putting all those pieces together? Workflow is a buzzword still. Is it actually about delivering a complete workflow solution, or is it still about customizing that because we may need to do more in our post-trade than we do pre?
I think customizing the whole workflow, automating the whole workflow is it's like painting the fourth bridge. You can be doing that forever. And regional banks are not blessed with departments full of IT people,
Yeah.
they're having to make decisions about what they prioritise over all that. But the roadmap is very clear. So yeah, there's a general, they know the direction of travel. Whether they get every single piece of the workflow done by next August is debatable. But yeah, they can concentrate on the bits that deliver most value to the organisation.
Yeah. Okay. And I guess we can't have the conversation about technology, regional banks, etc., without going to AI.
Yes.
This is our contractually obliged part of the discussion. What role will AI play in helping these banks deliver better service, and will it actually have a meaningful impact?
When I speak to people who are doing quite hefty algo trading, and they're really looking at searching for alpha, and they're doing some very, very clever things. Even today, many of them are saying, no, I'm looking at relatively simple correlation analysis. I've got enough work cut out looking at that. AI can help me look for points of inflection or whatever in the data, and I'll research those further. But ultimately, what they're delivering to me is the ability to do relatively simple correlation analysis. I think where AI will play an immediate role is actually on the analyst desk. So first thing in the morning, the analyst can produce an intelligent piece of work more quickly using AI, with the obvious caveat that a fool with a tool is still a fool. And to get the best out of generative AI, to get the best out of ChatGPT, for example, you've got to be asking intelligent questions, and you've got to critically evaluate what you're getting back. Because when all's said and done, all that generative AI is doing is making educated guesses. Now, the educated guesses are getting very, very well educated, but again, they're only as good as the available data that they're scouring, and the buzzword around that is the large language model. And we're seeing it already. ChatGPT is getting better and better and better as available large language models are scouring more and more data. The flip side is, on platforms, social media platforms like X, the content is obviously getting worse because there's a mean reversion to mediocrity, because the bots are actually scouring the stuff that is itself bot created. So you get this self-fulfilling, declining prophecy. So it's very interesting how all this is working.
Yeah, and so then is the key then for bringing that all together, is the key actually introducing AI processes to an SDP at very specific points?
Yeah, and being very clear about what it is and what it isn't doing. I don't think a bank needs to go out. It's not like a barber shop or a piano tuner saying get an AI-powered haircut, as some are doing, or get an AI-powered piano tuning exercise. I think overselling that capability is very likely to backfire.
Yeah.
But to produce better quality content quicker, everyone's going to assume that an intelligent analyst is using AI to do that. Yeah. The other thing, of course, is looking at data, looking at post-trade data, and also post-didn't-trade data.
Yes.
So I think figuring out why you missed out on the bid for a trade, or why you didn't get the rollover after a forward that you missed out, I think AI is going to help point you in the direction of that by asking intelligent questions.
As always, John, fascinating talking to you.
The time has whizzed by, as
yes, it has. Yes, and thanks for your time today.
Great pleasure.
And hopefully we'll do this again soon. Thanks everyone for watching, and we'll be back again very soon.